Hi, welcome back. You're watching MF Corner, and now we're going to talk about arbitrage funds. So, in the last year, every few months, this topic of arbitrage funds comes up because last year in March, sometime we saw them give negative returns. I think perhaps for the first time, if not after a very, very long time. But now it appears in this recent note that I was reading issued by Edelweiss Asset Management that there could be an opportunity for investors that lies ahead. So what exactly is this opportunity? And also, for those who may not know, what exactly do arbitrage funds do? What do they add to your portfolio? So joining in to answer all of these questions is Bhavesh Jain, fund manager at Edelweiss Asset Management, who also manages their arbitrage funds. Bhavesh, hi, good afternoon. Thanks very much for joining in. So first things first, we'll talk about the opportunity in a bit, but first, for those who may not know, can you explain how arbitrage funds really work and what place do they have in a person's portfolio?
Sure. Thanks for having me here on discussing one of the topics which is close to everyone's heart in Edelweiss. See, arbitrage is a very simple product. It is like something we do in our day-to-day life. We buy something from a place and sell the same thing at a different place and try to earn the gap between the buying price and selling price. The same thing we try to do over here. We buy a particular equity stock in NSE cash market, and at the same point of time, we sell future of the same stock in NSE derivative market. So this is how we try to earn the spread by capturing the difference between cash and future. This is what is known as arbitrage.
Okay, so in very simple terms, you see, you harness the difference between two markets, and that is the return. Okay, what exactly is this opportunity? I mean, I know for in very, very layman terms, when the market is volatile, it's easier to arbitrage or more beneficial. But we've seen a 900-point rally in the last 1 month. I mean, what is the opportunity that you see ahead?
In bullish market, when more and more people are extremely positive on market, like something what we are seeing for last almost 1 year now, where markets have actually doubled from bottom we made in March 2020. More and more people are taking this leverage opportunity. So you can see open interest on derivative is right now at lifetime high. It is close to 1,52,000 crore. That means more and more people wants to participate in this upside journey of market by taking leverage position. And as an arbitrager, I am the supplier of that product. So if demand for my product goes up, that means more and more people want to go long on future. I am getting much better price because I am the supplier, and as a result, I am getting much better spread. And that is why I think this is one of the best time to look at arbitrage of funds because not only on the post-tax basis, always arbitrage fund used to do better than liquid, but in last 2-3 months we are seeing arbitrage outperforming liquid even on a pre-tax basis, and then that outperformance is anywhere between 100 to 200 basis point. So this is one of the best time we have seen in last almost you can say 2 to 3 years. So this is a time where more and more people should look at arbitrage and try to gain maximum amount of profit from this opportunity.
Okay, I'll get to who should be looking at arbitrage, but before that, since you're talking about this opportunity that is there and perhaps the best in a very, very long time, will arbitrage outperform the other equity funds? I mean, I agree that there is an opportunity, but is the opportunity big enough than what I might be getting elsewhere? What is the alpha that an arbitrage fund can give me vis-a-vis, say, a large cap or a mid cap or any other equity fund?
I think the first thing, arbitrage, we push it or this product is an alternative to your fixed income fund. Though for taxation purpose, it is an equity fund, but all practical purpose, this is as an alternative to debt fund. If you see why you call a debt fund like a fixed income fund or an FD like a fixed deposit, because your interest component is fixed over there or your coupon is fixed over there. Similarly, in arbitrage, your spreads are fixed. That means on day one, just taking an example, say I buy a particular stock in equity market and sell future of the same stock, and say the price differential is 1,000 rupees in cash and 1,010 rupees in future. So I buy cash stock at 1,000 rupees, I sell future at 1,010, and the gap of 10 rupees is fixed. Now, irrespective whether this stock from 1,000 goes to say 1,500 or the stock from 1,000 fell down to say 500, my spread or my income of this 10 rupees will not change. So it is as good as your fixed deposit or fixed income fund. So your spreads doesn't change with movement in market. And that's why it should not be looked at as an alternative to say your large cap fund or your multi cap fund or any other equity fund. It is purely an alternative to your, you can say, debt auction, which is like your say fixed deposit or your liquid fund or low duration fund. So you should treat arbitrage as an alternative to debt fund, and nowhere it is an alternative to your equity fund.
Got it. So what is the risk profile then of an arbitrage fund? And I mean, is it suitable then, you would say, for a conservative investor?
See, all set of investors will always have some part of their portfolio into liquid assets, which they keep either for some contingency, some emergency use. So by default, arbitrage can become part of each and everyone portfolio. It is like you are keeping some cash in say liquid fund to meet emergency requirements. Similarly, you can park that money into arbitrage opportunities like arbitrage fund. So all your conservative investors definitely can have a larger portion of their AUM into arbitrage fund. Similarly, a lot of corporate clients who don't want to take equity risk or are not mandated or allowed to take equity risk, they can also park their surplus cash or surplus liquidity into arbitrage fund, wherein their intention is clear that this money is for anywhere between say 1 month to 1.5 years. They don't want to take any equity risk, and they just want to get better return on a post-tax basis compared to your traditional investment option like say fixed deposit or maybe liquid fund.
So this is, you say, a low risk product?
Yes, 100%.
Okay, and does it carry, any kind? I mean, since you said that it's a replacement to FD investors, is there any kind of, interest rate or credit risk at all?
So for this, I'll just try to explain what is our investment profile. So for every 100 rupees which we get, 65 to 70% of that goes into cash future arbitrage. As I said, this 70% is 100% hedge, irrespective whether Nifty goes up by 20, 30, 40% or goes down by 20, 30, 40%. It doesn't change your returns. So it is as good as fixed. Then remaining 30%, or you can say 30 to 35% goes into actual debt investment. A majority of that is in T-bills or you can say GSEC, which we place with exchange for derivative margin. So again, almost 25 to 27% in T-bill or GSEC, which is sovereign. So again, you can say credit risk is much lower, or you can say as good as nil. Only 3 to 5% of our AUM is in cash or other short-term paper, wherein we have a clear policy at Edelweiss that it will be deployed 100% into AAA rated paper. And for transparency, we also publish our fixed income portfolio every Monday on our website. So you don't have to actually worry about credit or duration a lot in arbitrage fund, because it is not more than say 5 to 7% of any fund.
Okay, got it. Bhavesh, thanks very much for joining in and for explaining this concept of arbitrage funds and the fact that perhaps good times could be rolling in for investors in these schemes. With that, we're going to wind up on MF Corner, but do stay tuned. The market action continues with the team of Closing Bell.